What's going on, everybody? It's Big T with GreenWallSt.com, back with another trading video, and today we're going to be talking about market crashes. The boogeyman, everybody loves talking about it, nobody likes thinking about it, but what does it mean for you as an investor, as a trader? Should you be worried about market crashes? Should you think about them whenever you go to sleep at night, or is it just part of investing for the long term? I'd like to break this video down into two parts and two perspectives. One from a long-term passive investing strategy and another from someone who may be actively short-term trading in the markets in order to try and generate additional alpha on top of their passive returns. So starting from a long-term perspective, I would like to look at a chart titled "The Difficulties of Trying to Time the Market," which shows that since 1930, the S&P 500 has returned 17,715%. But had you missed the 10 worst days per decade throughout that time, the results are astronomical. 3,793,787%. This is, missing Black Monday, missing the worst days in the depth of the financial crisis, missing, the tech boom and bust, all these really crappy days. If you were able to just sidestep them and get back involved in the market, your returns would be incredible. You'd actually be the best investor of all time. But the flip side of this is, had you missed the best 10 days per decade, the returns are only 28%. Now remember, had you just stayed invested, 17,715%. If you missed the best 10 days, it's only 28%. After inflation, you actually lost money. And the real crux of the matter here is that the best days tend to happen in the midst of a bear market, when markets are most volatile. Think back to March 2020, right? The depths of the coronavirus pandemic and what was happening to the stock market. Markets were down 10% one day, but they'd be up 10% the next day. So to think, and this is coming from somebody who day trades for a living, to think that you're in your long-term accounts going to be able to sidestep those bad days and get back in, before the good days happen. It's just the markets, when they're that volatile, it's all headline driven. It doesn't make sense. There's no way to do it. And this is coming from somebody, again, who day trades for a living. You cannot do it. So when it comes to a long-term perspective, the data shows that it makes much more sense to just stay invested. But of course, this is if you already had money invested in the market. What if you are just getting into the game? Maybe you've saved up a few $1,000 and you're trying to get involved in the market, right, for the first time. Do you buy stocks if they're at all-time highs, or, it makes sense. A lot of people say, wait for the dip, buy the dip. So does buy the dip really make sense? Let's look at some more facts. So the graph we're going to look at next is going to compare dollar cost averaging, which is simply buying stocks regardless of price. So buying stocks when they're high, buying stocks when they're low. Maybe you're buying them once a month, once per quarter, once per year. You are averaging into the market and you are just always a buyer of stocks, versus waiting for a dip of different magnitudes, because of course it matters. Do you wait for a 10% dip, 20%, 23%, 34%? How much of a dip do you wait? So we're going to answer that question now. So any random 20-year period between 1920 and 2020, if you had waited for a 10% dip in the markets, you would have outperformed dollar cost averaging 26% of the time. So about 1 in 4 chance of outperforming dollar cost averaging. Now, had you waited for a 20% dip in the markets, which is quite a bit more substantial, still 26% of the time you would have outperformed dollar cost averaging. And if you flip these numbers around, that means dollar cost averaging won 74% of the time. Now, if you waited for a 30% dip, now we're getting into real bear market territory. 27% of the time, buying the dip would have outperformed dollar cost averaging. And of course, 40, 50% dips, now you're talking about serious stock market crashes. The chances go up, and the percentage of times you would outperform goes up to 33 and 38% respectively. So a majority of the time, regardless of how much of a dip you are waiting for, dollar cost averaging into the market and holding throughout all dips outperforms trying to wait and buy the dip, time the market, and also selling out whenever stocks are low and buying them when they're high. The data just shows you have a small chance of outperforming if you can miss those days, if you wait for the dips. But the opportunity cost is so high. People can wait for a really long time. If you're waiting for a 50% crash in the markets, I mean, you've been waiting for like 13 years now. That could be half of your investment horizon. You know, most people, when they think about their long-term investments, they're thinking 20 or 30 years. You don't want to wait that long, right? And you might be right that markets are going to crash one day, but what if they double first? And then they pull back 20% or 30%, and the markets in absolute terms are actually higher after they crash than when you thought they would crash originally. It's too difficult. When it comes to long-term investing, the stats are clear. You dollar cost average into the market, and you don't try to wait for a dip. You just buy it all the time. You buy it when it's high, you buy it when it's low, you hold on for dear life, and you hope the shit doesn't crash 90%. That's what everybody's doing. And if it crashes 90%, you know what? Yes, the people that waited, they'll be right. They'll be right once, and markets will have crashed. Everybody loses their money. Guess what? Money doesn't matter anymore. You're going to need food and guns and big dogs, wolves, even to protect yourself, because money's not going to matter. It really won't. It will go back to like a barter system or something. That'd be fun. Nobody will care about investment returns if it falls 90%. So there's no sense, if you're going to invest, you could just sit out, you know, and let inflation eat away at your gains, or invest in real estate or something else, of course. But if you're going to invest in stocks, the data is clear. You dollar cost average into the market, and you wait. You sit through the dips. You don't try to get out during the bad times, because the good times are right around the corner. Whether it's, you know, 3 months or 3 years, markets have always outperformed. Now, of course, that doesn't mean over the next 100 years the stats are going to be the same, but that's what we have to work with. So that's what we got to roll with. Now, obviously, I day trade for a living on top of having my long-term investment portfolio work for me. So what does that mean for active traders? Should we be worried in our active trading accounts? The answer is absolutely. This is where I think understanding both sides of the market really plays a crucial role. Now, for those of you who have watched my videos, my live trading videos, you'll know that 99% of the time I am actually shorting stocks. And even though the indexes and a lot of the large cap stocks have gone higher this year because of the types of stocks that I trade, I've actually done really well betting that stocks will go down. If and when markets overall get volatile and those large cap stocks start trading like small cap stocks and they start falling 10, 20, 30% on any given day, I am actually equipped with the skill set of profiting while stocks go down because I do it every day. So as a short-term trader, you need to hone your skill set and look at the market objectively, again, by understanding both sides of the trade. If you only go long stocks, you're going to be looking at every stock when the market is crashing and stocks are crashing. You're going to be trying to find that reversal. Like, do I buy this stock here? Is it going to reverse here? And truth of the matter is, you're not going to know. Most of the time, you're just going to be guessing, and you're not able to actually profit from the stocks moving lower because you don't know what makes a good short setup. You haven't experienced what volatility really looks like. Therefore, you are woefully unprepared, and you're probably not going to make the right decision in the right moment. So as a short-term trader, yes, it's important, and the answer is that you're going to need to be prepared. You need to build your skill set, and you need to learn both sides of the trade. Therefore, when the time comes, you will be ready. And for those reasons, I'm not really worried about a market crash. I know whenever markets get volatile, I will be able to profit in the short term from that downward movement. And I know over the long term, markets are likely to recover. Therefore, there's really nothing to be afraid of. There's no uncertainty. Fear comes from uncertainty. It comes from lack of experience. But if you're armed with the data and you're armed with the skill set of actually trading, you realize that there's nothing to fear anymore. So that's what I think about market crashes, both in the long term and the short term. Hopefully this video helped a lot of you, whether you are, seasoned investor, trader, or just looking to get into the market. That's kind of how I view things. As somebody with, not a ton of experience, but 8 years of experience in the market, having lived through, some scary days in the market. Now, maybe not as quite as scary as like the financial crisis or the tech boom, but I would say, March 2020, there was some crazy shit. There were some crazy days happening in the stock market. And although, markets recovered very quickly, it wasn't so clear and obvious during the moment. So hopefully that helps. GreenWallSt.com. I will have a link in the description. We are still running a 5-day free trial. If you would like to join up, spend a week inside the Discord, watch all the educational material, and start to arm yourself with some of this short-term trading prowess. That way you are prepared when the time comes. Definitely do that. If not, and you just want to watch the videos, that's fine too. Thank you all for tuning in. Let me know what you thought about it in the comments, and I will catch you guys right back here next time. Peace out, everybody.